So last year I bought into a relatively new ETF that I had high hopes for in terms of providing me with a good amount of passive income on a monthly basis. What's more was this ETF was being touted as being a risk-managed fund, implying that during market turndowns, this fund was supposed to provide my dividend portfolio with downside protection. Unfortunately though, when 2022 rolled around, this fund's so-called downside protection didn't actually pan out the way I was hoping. So today I wanted to go over this fund that I made the decision to sell out of and discuss what I believe is now a much better alternative to this ETF that I was left really disappointed with. The fund that I'm referring to is the Nationwide Risk Managed Income ETF, which was ticker symbol NUSI. This fund is sometimes used in the trifecta covered call portfolio along with Global X's QYLD, RYLD, or XYLD. According to Nationwide's website, NUSI seeks to achieve its investment objective by investing in a portfolio of stocks included in the Nasdaq 100 index and an options caller. This includes a mix of written call options and long put options on the Nasdaq 100. Under normal circumstances, at least 80% of the fund's net assets plus borrowings for investment purposes will be invested in securities or derivative instruments linked to securities. Because this fund advertises itself as being more prepared for market turndowns, I was led to believe this would be a much safer investment during any potential bear market we might face. You can see that between its launch in 2019 and really all throughout 2021, the share price had remained relatively stable. The same was true for the dividend distributions. Throughout the entirety of this fund's existence, it had paid anywhere from about 16 cents per share to 19 cents per share. So I made the decision to buy 407 shares of NUSI, betting on this fund providing me with a hedge just in case the market were to tank at any time in the future. But little did I know what we'd be in store for in the following year when 2022 came about. Up to this point, given NUSI's share price performance this year, this risk-managed fund strategy has not been panning out well at all. You can see it's currently down over 29% for the year, which is worse than the market as a whole. If we compare this to the S&P 500, we can see NUSI is down considerably more than the market. For being a diversified ETF with holdings like Apple, Amazon, and Pepsi, I really didn't expect it to drop like it has. I think it's pretty clear that this plan that Nationwide had for this ETF faring better than average in a bear market hasn't actually panned out the way they were hoping. The good news though is that when we factor in the dividend distributions to its total return, it's not nearly as bad. NUSI currently offers a dividend yield of 9.47%, which is exceptionally good. So when we use a drip calculator to determine this fund's total return for 2022 and compared with the S&P 500, the results aren't as bad compared to the share price alone. Although NUSI does offer monthly dividends, which is another attractive feature about this ETF, the amount this fund pays in dividends has also been shrinking as time moves on. Because this fund uses call options to generate dividends, the amount it pays each month can vary. But you can see it paid about 18 cents per share in December of last year, and its last dividend, which was recently declared, fell to roughly 13 cents per share, which is a decline of nearly 28% from last year. NUSI is just one of several funds by Nationwide that claims to provide a risk-managed way of receiving monthly income. The other funds include NSPI, or the S&P 500 Risk-Managed Income ETF, NDJI, the Dow Jones Risk-Managed Income ETF, and NTKI, or the Russell 2000 Risk-Managed Income ETF. According to this brochure on their website, it says they seek to provide high current income with a measure of downside protection in falling markets and the potential for upside equity participation through exposure to some of the most well-known domestic indexes. As of the making of this video, all three of these funds are down, a lot, and so are their dividend distributions. The way NUSI works can be a little confusing, especially if you're not too familiar with options. On their website, it lays out their investing strategy and how they generate income. It says, Step 1, NUSI purchases in full replication the constituents for the Nasdaq 100 index. This index is comprised of the top 100 largest and most innovative non-financial companies listed on the Nasdaq stock market based upon market capitalization. On their website, it shows that historically this index has outperformed the S&P 500 by a lot since at least 2012. But this year the Nasdaq 100 has crashed significantly more than the S&P 500, as you can see on their website. This is because this index is very tech-heavy, which have fallen a lot this year. And as you can see on NUSI's website, nearly all of their largest holdings are tech companies, with one exception. Steps 2 and 3 are given more detail, which involves deploying a rules-based options collar strategy that provides a constant, fully financed portfolio hedge, and then the monthly dividend distributions are paid using a portion of the premium generated by the call options. And below that, it has a graph that shows how this process works. Using a portion of the premium received, a Nasdaq 100 index put option is purchased to fully hedge the portfolio and seeks to protect against potential losses in the underlying equity portfolio. A near at-the-money to out-of-the-money Nasdaq 100 index call option is sold with the intent of generating a premium. And then a dividend distribution is paid to investors each month using a portion of the net credit generated by the caller. This whole process takes a management team to carry out, so NUSI isn't a passively managed fund. Because the people who manage this fund need to be paid, it does charge a much higher expense ratio than average. At 0.68%, it's the highest cost ETF in the covered call trifecta portfolio. And given the performance of this fund and how it hasn't been meeting its objective, I don't see the expense ratio as being worth it. And if you remember, I'm actually not opposed to paying higher than average expense ratios if the investment is worth it. For example, I like closed-end funds, which charge much higher expense ratios than ETFs on average. But CEFs have to provide me with consistent, dependable income before I'd be willing to consider them. Earlier I compared NUSI to the S&P 500, but now let's compare it to the Nasdaq 100 since NUSI buys funds in this index and their management team is supposed to do better than the index when there's a downturn like the one we're going through. We can see NUSI has just barely done better than the index, despite having a team of experts who are supposed to do a better job during bear markets. Granted, this only accounts for share price and not dividends, but remember, the dividends have been falling a lot this year. Actually, you can see for nearly half the time this year, this fund's been doing worse than the index. With these facts in mind, I made the decision to close out of my position of NUSI. This defensive strategy that I was counting on clearly didn't work well. So looking for a better alternative to NUSI, the pick I landed on was an ETF that I'm already a big fan of, which is JEPI, or the JP Morgan Equity Premium Income ETF. This fund seeks to deliver monthly income and equity market exposure with less volatility. JEPI has a defensive equity portfolio that employs a bottom-up fundamental research process with stock selection based on management's benchmark. Upon doing more research on JEPI, it's clear that this fund, in my opinion, is the superior choice compared to NUSI. It currently offers a dividend yield almost identical to NUSI's at 9.82%. Before 2022 rolled around, JEPI had experienced a significant amount of growth in terms of its share price. From its launch until December 31st of 2021, the share price of JEPI grew by over 26%. The monthly dividend payments from this ETF have varied quite a bit more, but it's actually been paying quite a bit more this year compared to 2021. JEPI is also a lot less expensive than NUSI. Its expense ratio is only 0.35%, which is almost half of what NUSI's is. JEPI is also much more diversified than NUSI, with their holdings spreading out across more sectors including industrials, utilities, real estate, among many others. It currently holds 121 holdings as of the making of this video, which is about 20 more than Nationwide's ETF. In terms of total returns for this fund, it's performed significantly better than the market when dividends are factored in. You can see for 2022, JEPI has performed literally twice as well as the S&P 500. So going forward, I'm planning on giving JEPI much more of my attention, and I'm choosing to leave NUSI behind. While JEPI doesn't claim to be a risk-managed investment during bear markets, at least in this fund's description, it's still done significantly better than NUSI, which claims to have a hedge against a down market. If you hold NUSI, it's still up to you if you ultimately want to hold out or not. Just be sure to come to your own conclusion and perform your own research before choosing to buy or sell any security. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. All right, thanks again guys so much for watching, and until next time, take care.